Hi, and welcome to our LinkedIn Live broadcast on the release of the ISM Services PMI Report. My name is Dan Zeiger, and I'm a senior writer and editor for Inside Supply Management, which is Institute for Supply Management's member publication. And welcome to our discussion as we break down the Services PMI data for December. Like many people, I'm now on day 3 of post-holiday eating detox, and I can state authoritatively that those holiday calories do in fact count. But much more importantly, so does the Services PMI for December, a reading of 54.4%, and that's the highest of 2025. You might remember that contrast with the manufacturing data that revealed the lowest PMI of the year, but at least in the services sector, it somewhat echoes the optimism for 2026 that panelists expressed in the ISM supply chain planning forecast 3 weeks ago. So as we finish with a flourish, is it a sign of things to come this year? That's one of many things we'll discuss with Steve Miller, who is the chair of the ISM Services Business Survey Committee. And Steve, I think the statute of limitations is 10 days. So I will wish you a happy new year. And welcome to our discussion. Just what stood out in the December data to you?
So, the new orders, new orders number was quite a boost. So I had gone on the record as to expecting kind of a 52-ish type number in December, and I was wrong. Great to see the employment number pump up. We'll talk about some of the reasons that were stated from the participants on those. But for me, you look at near-term trends, they look really positive. You look at the semi-annual, and very positive on the first half of next year. So all of that stuff hangs together. If you look at 2025 versus prior years, it's the lowest number, average PMI for a full calendar year of any prior year that actually had expansion. So there were 2 years, 2008, 2009. 2008 is when we started reporting. That they were both down. They were both in contraction for the average for each year. Every other year has had a higher average PMI than 2025.
Yeah, that's some great history. Thanks for sharing that. 2008 and 2009. Yeah, no surprise that those were average contraction. Let's talk about, you touched on the new orders and talked about what a big surprise that was, 57.9%. I guess you might expect that number to be a good number during the holiday season, but I also went through the tables, and it was the best for a December since 2021 when it was 62%. Just talk about how those maybe new orders and business activity kind of exceeded expectations, especially given the 12-month performance that you just referred to.
Yeah, when you looked at the comments from the respondents, high degree of seasonality, and seasonality both from consumer behavior, retail, holiday time, as well as end of year budgets available, both from a customer side as well as internal. And then the last piece of it being a positive and a negative side on healthcare. So the positive side, people still had balances on their FSAs, and they're working to get those things run out before the clock expires on them. The other side of it, though, is the flu vaccine has not been very effective. And so they're seeing a higher degree of flu cases. So on the new orders and business activity in particular, we saw that type of commentary, a lot of pointing towards seasonality, end of year, getting ready for next year, even a little bit of getting ready for Chinese New Year in terms of making sure enough inventory is in place for when things shut down there at I believe it's end of January.
Yeah. Well, let's stick with a little bit of history, and then we'll dive into some specific index readings from December. But as you noted in the report, the Services PMI, it's been on a downward trend since it registered 62.6% in February of 22. But you pointed out the November and the December readings from 2025 were in line with pretty much the same months in 2024. To give you some historical context, November 2025 was 52.6%. It was 52.5% in 24. And December, what we're talking about, is 54.4%. It was 54% in December of 24. Just what do we make of those reads, and how encouraging is it?
Yeah. So one of my favorite quotes, I may have used it before, Dan, is "Figures don't lie, but liars figure." So it's fun for me to point out that that the November and December numbers are in line with last year. If you look at the Q4 average, they did some other calculations. Q4 2025's average PMI reading of 53.1 is tied for the second lowest Q4 reading over the last 10 years. The lowest was 51.7 for October to December of 2023. So not, from that perspective, okay, well, not inconsistent with what we're seeing in terms of the overall 2025 average, but we had kind of a crappy summer. When you look at the numbers in May, June, July PMI, pretty rough patch. When you look at what's happened since May to the end of this year, we are on, across all four sub-indexes, a positive trajectory. So even though we were in contraction in employment, we've seen, I believe it's 5 months of consistent increases in those numbers. Finally, we're above 50 again. So slower and slower contraction, but then to expanded numbers. So the 2-month view, positive; 3-month view, not so much. Looking back to when kind of a reversal in the trend started, which was May, we've seen some very interesting positive trends there. 8% on trend for new orders increase, which is tremendous.
Yeah. All right. Well, yeah, let's get to, some specific readings. And, the employment index also got a lot of attention, and, especially in light of the various other job reports that are out there, ADP, and then the federal data is going to be coming soon. It expanded 52% in December. That happened for the first time since May, when it was 50.7%. And, this jumped out at me. You see it go down and up and down a little bit. I don't know if it's ever gone down this much. Companies surveyed 12.5% indicated staff reductions. That's down from 18.5% in November. But we should also note that the share reporting additions to staff also decreased slightly. What to make of that? I mean, is it a holiday seasonal dynamic, or, just what does the picture tell us?
Yeah, the commentary supported a holiday seasonal, which was a surprise to me, Dan, because I expected, since we saw 48s the prior 2 months, I expected that's kind of where we would be in December as well. We saw increased consumer spending during the holidays. Kind of, got to feel good during the holidays. There's enough negatives out there, so let's go. Let's go be happy. It would be interesting to see the credit card balance numbers in Q1, but increased spending. You got to have people to support them. The accommodations and food services, for the last 2 months, we saw an expansion towards the top of the list, and so I think that had a positive spillover. And we saw from the commentary, seasonal impacts were called out several times by companies in terms of what's happened in employment. One of the other dynamics that was mentioned a couple of times was the ability to hire qualified staff. So it wasn't necessarily the openings, but it was actually employment, being able to fill roles with qualified folks based on some of the job environment normalizing a bit. So that was positive. And then a little bit of commentary around unfreezing backfills for attrition during the year. So I think all very positive signs. I wonder, Dan, just a kind of a nagging thing in the back of my brain is how much of this is swinging for the fences in the last month of Q4, because we got to do something to see if we can close on the gap for what we projected for 2025. And we'll see that. I mean, we'll see that in the earnings results and reports that come out in January and February. But I have a little nagging. I'm hoping that's not the case, but a little nagging thought of, maybe it was just trying to get as much as you can out of whatever's there. Our mid-year projection of first half for services having some really good revenue growth makes me think that it's not it's not that, but I do have that kind of nagging thought that maybe that drove a bit of the performance, and such a significant performance jump, both for new orders as well as for employment.
Yeah. Yeah, we won't talk about nagging thoughts on the back of my brain, but that's because that's a dangerous territory to go. But yeah, I mean, with the post-holiday lull, I mean, we talked about it last year at this time, and we'll talk about it more in general later. I have a question on that, but yeah, that's certainly a thing to watch for. We'll keep an eye on that index in particular in January and February. Backlog of orders, Steve. You know, we talked about that last month at this time. About the volatility continuing, how that index is kind of zigzagged. I mean, it's stayed in contraction, but the movements have been really heavy. It was 42.6% in December, which was down from 49.1 in November. But you know, what caught my eye when I read the section on that was some of the panelists commenting about lower demand and faster lead times. I mean, is this a potential yellow or red flag to be on the lookout for?
I don't think so, Dan. I think that that's positive from a productivity standpoint. You know, the lower backlog you have, the more competitive you can be, the quickly you can adjust demand from customers. So I think I think there's a positive piece of that. Of course, in the software industry, backlog is good because it means you sold business that you haven't fulfilled yet based on the length of the contracts. So however that works. The trend from May to December, just because there were such weird numbers, Dan, and looking at the new orders and the backlog of orders, I charted them from May through December to look at what their behavior's been like. If you do an every other month chart for each of those indexes, all 4 lines are increasing. So you've got the trend on the backlog of orders. We're up 2% from May through December. Every other month, that's one of the ups is increasing over time, and every one of the downs, actually from August, is increasing. The June down was not as dramatic as the August, October, and December. Then when you go to the new orders, 8% trend line from May. If you look at the May, July, September, November numbers, they're all increasing. And then when you look at the June, August, October, December, they're all increasing. So for me, what we're seeing is a reverse action. When new orders is up, backlog is down. When new orders are down, backlog is up. So it's like new orders come in, we have a backlog for next month. New orders drop down, then new orders go up again, and it cycles like that. It's very interesting. Again, back to the figures don't lie, but liars figure. I've only looked at it for the May to December timeframe, and I'm looking forward to between now and next month taking a look at the data and seeing from a more of a trend perspective over the since 2008 when we started doing the ISM Services PMI. What type of linkage there might have been between the behavior of those two indexes.
Yeah, no, that's a good point. I mean, that's one of the fun things if you become a student of the data, like I want to be, or try to be, how those indexes work together, or work in tandem, or how they relate to each other. And yeah, that's a good tutorial on that. So thanks a lot. Prices. I'll kind of make this a combined question for you. The prices. Moderated. They're at 64.3, down 1.1 percentage points from November. But as you pointed out in an interview earlier today, I mean, that's still pretty high. I mean, it's definitely not coming down substantially. And then the tariffs impact, it seemed in the November, the comments, they were less prevalent in the commentary in November, but they kind of came up a few times in November. You noted it in your summary to the report, and one panelist in particular specifically mentioned coffee, although the administration has done a reset there. But it's just an opportunity, Steve, in general, just to discuss the prices impact and the tariffs, where that issue stands in general as we begin 2026.
So. This really interesting one for me, Dan, on prices, because there's so much focus on the Fed rate and how that might impact prices overall, and how prices paid within various industries may impact inflation overall. We're seeing inflation moderate. We're seeing prices paid, at least in the services industry, moderate as well. But like you noted, above 60 still. Trying to look at seasonality there. The 51, what was it? Sorry. The prices paid number was actually the second lowest December since 2019. So for me, that's a positive sign, is that we are now, maybe not a positive sign from a bottom line perspective, but a positive sign from an inflation perspective. We're seeing that pressure start to reduce, but that pressure is still there. Even though the number's coming down, it's still a significant expansionary number above 60. It doesn't look like that's flowing through to prices paid. It may be getting absorbed, and if we look at the commentary from the mid-year, more than 50% said that we wouldn't be passing those on to our customers. Either they weren't impacting us or we would absorb them. So I believe it was somewhere in the 50 to 60% combined, if my memory serves. For me, the counter to that is that, unlike manufacturing, if the Supreme Court rules that the tariffs are not legitimate and those need to go back, we won't see the kind of boost maybe that manufacturing would, because it just didn't impact us that much.
Yeah. So yeah, some of the commentary that, I saw after the PMI came out, suggested or projected that, maybe at least in the services sector, that there would be some clarity in the tariffs issue over the coming months, and also with the tax cuts that are taking effect, that that will help. We'll certainly see that. Two indexes that we haven't really talked about, kind of amazing, in recent months. Haven't talked about them that much. I mean, we've talked about them, but given the tariff situation, not as much as you would expect. But they caught my eye in December, and that famed noted importer exporter Art Vandelay, as we continue with all the pop culture references, would have loved this December data. The exports and imports both went into expansion. The new export orders, 54.2% for the first time in 6 months. That was above 50, and imports 50.3%, the first time in 4 months. Either of those numbers surprise you?
The exports really surprised me, but kind of in line with the new orders. New export orders, as well as the new orders as one of our core four for the PMI. Again, commentary around seasonality, for me, what I want it to say, didn't see it in the commentary, but I think I can infer it in the numbers, is we were getting back to a little bit of normalcy, is that things are working their way out. And so now we're going back to some of our, and our customers are going back to some of their normal behavior, where we're getting some of that overseas demand. And we're also seeing our ability to import without fear that those longer lead time items aren't going to bite us in the butt, because there's some certainty around either the numbers being the same or them dropping if the Supreme Court comes out with a change.
Yeah.
Yeah, but very good numbers, Dan. I think from a stability and from an overall business standpoint, very positive signs. The 54.2 on the exports. How far do we have to go back before we see a 54? Gosh, is that right? October or September of 24? Is that right?
Yeah, I have the table in front of me, but I closed it. So yeah, I'll have to.
September of 24 was 56.7. And then you have to go, then prior year, you see a bunch of numbers that are in that range or even higher, up into the 60s. So it's really, very positive, and the highest number we've seen in over a year. So that's good.
Yeah, good. Well, we alluded to this before when we were talking about employment a little bit, and as we discuss, at every time this year, there's always that. It's a factor for the services sector. That post holidays lull. For example, people who are on eating detox tend to go out less, and some other factors that come in. Any signs that this lull could be? Do we expect it to be normal or abnormal in either direction? Just what does it look like, based on what we know about the data and comments?
So inventories where they are, it doesn't seem like we're preparing for a downturn. Inventory sentiment is a little bit, even though it's above 50, it's a little bit lower. So we're not saying, wow, we've got way too much inventory like we did earlier in the year. The numbers looking better. So from a forward-looking standpoint and looking at the employment number, it doesn't look like people are expecting a pullback in Q1. Mm-hmm. And then referring also to our mid-year. Mid-year was very positive in terms of what people are expecting to see in the first half.
Yeah. Just a kind of a chance to piggyback that on a question. Just, it's a ideal time. We're looking ahead to 2026, and you noted, the upward trajectory, especially in some of those key sub-indexes. I had a coach in high school that, used to say, it's not location, it's direction. And obviously the trends of those indexes, as you pointed out earlier, were kind of looking good. Based on that and, some of the other dynamics that we've been talking about, just kind of give us your scouting report, so to speak, for the services sector in the next few months, hopefully.
Yeah, I would be surprised if we're not up higher than where we are today, mid-year next year. I think the expectations are consistently high in the services industry, and the trend since May has been positive. You look at all four sub-indexes, we've seen a positive trend on each of them since the beginning of the summertime. And there's nothing that I'm seeing as a red flag that's saying we shouldn't expect that to continue. I don't expect that. With a 51.7 average for 2025, I don't expect we're going to have a 60, for the average for 2026. But with some of the tax law changes, and unless something really bad happens around Ukraine or Venezuela, which, the use of, what was the Freudian hydraulics was the term that I heard, long time ago, in one of my, one of the management classes that I took in the day. And it was, when you put psychological pressure on people, psychological, and I'll add economic pressure on people, the place where it blows is not necessarily where you expect it to. I think if anything, that would be my worry. Also coupled a bit with the weakness of the U.S. dollar, where that's sitting now. So between those two, if it gets much more expensive to buy anything, regardless of tariffs, that would have some negative pressure on us. And then on the other side of that, if there were some geopolitical disruption, Taiwan or something worse in Ukraine, it's terrible. I don't mean to minimize that, but if there were something broader geopolitical event that certainly could create disruption. Those both seem like very unlikely situations. So I'm confident, after a little bit of doom and gloom there for the last 2 minutes, positive for 2026. I think we're going to see an average, probably in the low sector or the middle of the low sector of the 50s, like 52, 53, maybe even 53 and a half for 2026. But we'll be well above that, I think, in the summertime as we continue this positive trend over the next 6 months. Fingers crossed.
Yeah. Well, that just reminds me, one of our favorite articles in Inside Supply Management magazine every year is the annual economic outlook. I did that article last year, talked to Steve about it, and I remember many of his comments were very prescient. And I'm not doing the story this year. My colleague Sue Dorfler is, and Steve and our manufacturing chair, Sue Spence, are both interviewed for that article. So you'll want to check that out when it comes out in about a week or so. They'll have some great insights about what to expect, not only in their respective sectors, but for the overall U.S. economy in the coming year. So yeah, thanks a lot, Steve. But I'll wrap up with that question that I always ask you. I mean, is there anything that I haven't asked, or anything that we haven't talked about to this point, that might be important to include, especially, if I'm a CEO and, want to know to take away from the data, and especially as you alluded to just a minute ago, with all the geopolitical activity and the potential, hurdles right now. Go ahead.
I would be in. I'll maybe revisit what I said last month as well. Mm-hmm. The employment situation is improving in terms of hiring activity. From personal experience over the last 5 months, difficult to hire the right people, particularly in supply management. Availability, location, and capability kind of all bundled together. We're seeing some success from our respondents about the ability to hire people. That means there's less qualified people on the market if they're having success in hiring. With the employment number where it is and expectations in the services industry going up, and my advice would be get those people you need now, because the hiring environment is only going to get tougher for people that have the advanced skill sets in our field, as well as some of the emerging capabilities around how to adopt and adapt to AI capabilities within business. So it looks like it's going to be a fun first half. I hope so anyway.
Yeah. Well, yeah, with that, like we did with the manufacturing call on Monday, I'm sure people have a lot of work to catch up on after the holiday break. So we'll dismiss the class a couple minutes early today and give that time back. Hey, Steve, thanks a lot. And we'll talk to you in February. And thanks to you for joining us today. In a little bit, you can go to ISM's website and read the roundup article that details a lot of what Steve and I have discussed here. And if you want to be a part of the ISM Manufacturing or Services Business Survey panels that compile data for the ISM PMI reports, you can go to ismworld.org, join the panel for more information. We'll see you back here next month when we break down the ISM PMI reports data for January. And as usual, at this time of year, we'll have some seasonal updates to talk about as well. So for Steve Miller and some good people who helped us behind the scenes today, they are Christina Cahill and Jennifer Stevens. I'm Dan Zeiger. We'll see you next time.